Investing. What's that factor?
Hi everyone, welcome to Investing. What's that factor? Today I'm going to talk briefly about the value factor. Hopefully you know me by now, but for those that don't, I'm Dale from Modules Financial Planning. So when assessing shares, there are a number of factors you might look at in an attempt to make an above market return. These are factors which, after academic research over the whole of the market, appear to show consistent outperformance over the long term. The most well-known and easiest to understand factor is the size factor, and so that's why you might always hear about small companies funds. Another of these factors is the value factor, which I'm going to try to explain now. So value investing has been used since 1935 by Benjamin Graham, but became more common in the 1990s after research was published by Professors Eugene Fama and Ken French. So a company's share price can be measured and placed on a scale which has value at one end and growth shares at the other. This is based on the analysis comparing its share price against the financial characteristics of the company. A value share is essentially a company where the share price appears to be trading lower than you would expect when its fundamental financial measures are compared against other similar companies operating in the same sector. These financial measures are its assets, its earnings, its dividends, and its cash flows. So these may reflect very well in the market when compared against its rivals, but the share price may not have grown by as much. And as a result, the future earnings of these companies may be viewed as being more unpredictable or more uncertain, and therefore a riskier asset. And as we all know by now, the more risk you take, you should be rewarded with an expected higher return, in theory anyway. So a value stock is normally an older, more established company which has reached a level of stability. And so while the share price may not appear to grow as much, these companies will generally pay you a fairly healthy dividend. So to follow how value shares have performed, you can view the MSCI World Value Index. Some of the companies in this index include companies such as Pfizer, AT&T, who are the mobile phone network in the USA, and Johnson & Johnson, the company which is responsible for a lot of the products in your bathroom. UK value companies are dominated by financial companies such as Lloyds Bank, HSBC and Barclays, large shopping chains like Tesco's and Sainsbury's, and a surprising one might be Royal Dutch Shell, the oil company. So academic research has proven that by incorporating value shares in a portfolio, they'll go through times of seemingly like they don't do very much when compared with the other parts of the portfolio, and then all of a sudden they outperform everything else. This period of underperformance can last for many years. In the meantime, however, they'll generally continue to pay healthy dividends, your reward for holding the shares of that company. At the other end of the scale are the growth shares. So these are the shares in companies where the share price continues to go upwards faster than all of their other financial measures suggest that they should. And so a growth company is one which you might hear about more often. They're often the new, exciting, sexy tech companies going through quick, sustained growth, such as Netflix, Tesla, Amazon, and Facebook. An all-out value investing strategy isn't for the faint-hearted. You'd go through long periods, often several years, where you'd underperform relative to the market. But then there will always be that period where it'll outperform everything and eventually catch up. But by including a value fund as a small element of our overall investment strategy, it's an attempt to build consistency through the business cycle over a very long time. And while the price performance of the value fund may lag the other funds, you'll get the reward from the dividends. So it's for this reason that we include value in our long-term investment strategy. So hopefully that's been useful and not too confusing, and I'll see you later.